Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Everything is, we're not going past Friday with any of our positions yet, and we're keeping them extremely far out of the money. So our long is 200 points out of the money because we've seen moves, so we have a 200 point, probably a 150 point 1x3 put spread, but our long is about 150 points below the market. So you've got this kind of, we call it a bear trap because we are seeing these, down 90 point days. If you put that too close to the market, one, it's going to be expensive, and two, you can get blown through really quickly on your ratio.
All right, welcome back, people. I feel like we're a little bit of Fox News today, having Nancy Pelosi on. Or Rush Limbaugh going on MSNBC to talk with Rachel Maddow. No, we're not getting political right before the election. I'm talking about having an option seller here on the pod, where we've typically had more long option, long vega, long gamma, and so forth managers than you can shake a stick at. But there's an option seller for every buyer, right? So why not talk to the other side? Why not hear how a pro manages the short option risk we all think we know so well? So to help us out with that a bit, we have Mark Adams. Welcome, Mark.
Thanks, Jeff. Good to talk to you.
You too. So thanks for coming into the hornet's nest a little bit here. Mark's the assistant portfolio manager and chief quantitative officer, the CQO. I haven't heard that before. I like that. At Warrington Asset Management, who's a sub-advisor to the Catalyst Warrington Strategic Program, symbols CWXIX, and the Rational Tactical Return Fund. The ticker there's HRSAX.
STX.
HRSTX, and longtime options trader. So I'm excited to dig into how he views the market and the option world. So where are you, down in Dallas?
Yep, Dallas, Texas.
Dallas,
whole firm's
Texas.
Down here. Yep.
And we were just chatting before we got started. It's cold there. Cold like
of course.
Chicago.
Oh, yes. This is our winter right now, I guess, 40 degrees and rainy, but, it is what it is. And
are you a Cowboys fan?
I was born into it, and I'm not going to admit too much of it right now. We'll hang our heads a little in shame, but, it ebbs and flows. We had a good run about 20 plus years ago.
Yeah.
It was fun, but not so much right now.
Brutal this year. My buddy's a Cowboys fan. I just keep texting him like, man, it just keeps getting uglier and uglier.
It's at a certain point, I want us to lose to, improve the draft pick, but, it's a little early for that.
And then all the Packers fans are like, you took our terrible coach. Good luck.
Oh, yes, we definitely did that.
And so where you in the city or in the burbs or what? Nobody's
just outside the city, not that far, probably 10 minutes from the office. So not too bad. It's a big spread out city, but I live relatively close to uptown area.
Yeah. My brother's down there in Addison.
Okay. So it's a little north of me.
Out.
Yep. Not too far.
And so you guys been going into the office or what? What's the
in shifts, right now I'm at home, some people go to the office, we've got a smaller space but we only have 6 people. So we can kind of, some people be there, some remote. And that's what's so easy about this type of setup. You can work from the office a couple days, work from home, others, but it really doesn't impact us. It just doesn't. That's what we've all kind of learned is that, being in the financial services space, we aren't making widgets. We don't need to physically touch something in order to produce what we do. I can do, we do this via phone, via chat, via text message all day long, and it works just the same.
And have you found it's been actually easier to talk with people? Because Dallas is not necessarily on the hedge fund route.
Right.
Of allocators and right. So found it like you get more meetings, more calls.
Definitely. Especially at the onset. I mean, when, the stuff hit the fan in March, we had pretty decent performance in both our funds. So it was all day, every day phone calls, which is great. and it's continued because we've had okay numbers. And, and as people are, still reticent to get up and move around, how many of these have we done? I mean, I've done, these type of interviews, multi, kind of one on 50 different kind of presentations, screen share. They work really well. And we've seen, especially because we have some European investors, we can't get over there. So doing these type of things makes life a lot easier. And frankly, it's a whole lot cheaper and easier. We don't have to take a 2-week trip to see 5 people. That's a day.
I think we're going to see more and more of it. What was just in the news? Singer in New York is going to bail and move to Palm Beach. And
I can see that. Yeah. For those guys, taxation too is a big deal. So exactly. For us, we've got that taken care of for the moment, at least.
Right.
So.
If not bigger.
Yeah.
Right. They'll do the first step's Palm Beach. The next is Puerto Rico for those guys.
Exactly. Probably. Yeah. That's how it goes.
Cool. And then, but you were originally from St. Louis?
Yeah, I went to undergrad in St. Louis, and that's where I worked a little bit. I'm originally from Dallas.
Okay.
Born and bred.
So where in St. Louis? Billikens?
No, WashU in St. Louis.
WashU, okay.
Yep.
Which had it was the most expensive undergrad in the country there for a little bit. I don't know if that title.
Maybe. No, I was there forever ago. So it was, I graduated in 2000. So it's been a bit. Yeah, I'm stunned. My kids look at that school. I've got now. My oldest is a 15-year-old, so he's into computer science. He's like, "Oh, WashU has a good program." I was like, "Well, okay, let me start saving even more money then." So yeah, it's embarrassing how all colleges are like that, though.
I actually went. My wife's cousin graduated there, and we drove down. And I went to the graduation there about 5 years ago. So
yeah, I love St. Louis.
It's beautiful campus.
Great place to visit. I always say.
And I can't remember if we comboed that with the eclipse. We went down through St. Louis to see the eclipse. What was that? 2 years ago?
Oh, that's right. Yep. You're right. I think they had a pretty good view up there.
So give us so from St. Louis back to Dallas, how'd you end up at Warrington? What was
sure. So if you rewind far enough, after undergrad, I majored in finance business, the business smorgasbord there. I started working for the Federal Reserve, and I knew pretty quickly that I wanted to be in investments. This was at 2000, we're all bitten by the stock bug. So I'm sitting here day trading during often, when I should be working, so I knew really quickly that
at the Fed you were day trading.
Yeah. Well, not too aggressively, but enough.
Right. Did they allow that?
Yeah, back then I wasn't in the research department. So that was, nothing. And this was, back when the E-trades of the world were all still going and, pretty easy to do that kind of stuff. So started there. I knew pretty quickly I wanted to get into the investment field. So, but my degree was in, finance management, not really in investments. So that's when I knew I needed an MBA. So that's when I came down to SMU a couple of years later. And that's where the connection to Warrington came. When I needed an internship, after the first year, I canvassed the SMU alumni in the Dallas area, talked to, a couple dozen people, some good fits, some not. And that one of the people I talked to was a gentleman named Scott Kimple at Warrington. I go meet with him. And at that time, he was managing about 10 million, friends and family, some clients, nothing crazy. 10 million for a hedge fund, as you know, is pretty small. But he kind of said, you know what?
Not too small 20 years ago, though.
That's the thing. Back then, it was fine, and now it's a different world. But back then, it was him and an assistant. And so I said, all right, here's what I'm looking for. Here's what I can do. And he said, well, I'll tell you what, can't pay you anything, but I'll intern. You help me out. I'll teach you some things. And at the end of the summer, I'll give you a good recommendation. Perfect. It's exactly.
Were you like Eric Dickerson got a Trans Am? I need to get something.
I know. I need something on the table. Come on, help me out here, partner. But I knew, that's the thing. Experience is the ultimate thing. I need to have that transition. I need to get away from the Federal Reserve type of experience toward the investment management side. The summer progresses. Scott and I hit it off swimmingly. We complement each other really well. And toward the end of the summer, he's like, hey, can you stay on during the school year? Sure. Happily. Start work a couple days here and there. We keep progressing. And then, later on in the year, he asked me, so how's your job search coming? My first response was, you tell me, how is it coming? And very quickly, he said, well, this works pretty well. So I don't want to say the rest is history, but we've had a great partnership ever since. Going on
how many years
20
ago?
years. Gosh, it was April of 2002 when I walked into his office. So
you haven't killed each other yet. So
exactly. Not quite 20 years, but long enough. And we've a couple funds, couple mutual funds, couple usage funds, everything later turned into a real company here.
It goes fast, right? Like when John Cummings and Jeff Eisenberg, and we've all been working together since 2002.
Yeah,
when we started Attain, and I'm always like, we're on a call and we're like, Jeff and I have been working together for 20 years, and we're like, what? Yep. That can't be true.
I know. We joke about that. It's like when I talk about having like a 15-year-old kid and things like that. I remember it's like, oh, that's when he says it makes him feel really old because all of a sudden I've got a high schooler.
It does. My new life advice for people is, because you probably got private tuition for not just college, but high school and grade school down there. Not as much as Chicago, but I'm like, when you meet a girl, right? It used to be when you get married, start saving for, or when you have a kid, start saving for college. Oh. Now it's like when you meet a girl, start saving for grade school.
Oh, it is. It's like it's 3 kids in private school here, so it's just that's part of the deal. We invest in our kids' intelligence, I guess.
Let's hope it pays out.
That's the plan. That's the call option.
So let's switch a little and give us kind of the elevator pitch on what Warrington does, and you can start quick and then we'll dig into the details.
Sure.
So there's a lot going on there.
Yeah. I mean, really at the end of the day, we're option specialists. You take, the 30,000 foot view is that, we trade short-term options in 2 different strategies that both are founded on the same research. And we kind of take this kind of bifurcated approach where we say, we use technicals, a number of off-the-shelf indicators that anyone uses, MACD, RSI, et cetera. We have a number of proprietary ones we use that, we've talked about ad nauseum to a number of people all over, put them on our website, everything. It's nothing super secret. We'll share all we can, but that starts with the technicals, and everything is very short-term. Like I mentioned, either, tactical will go 1 to 2 weeks before expiration. Strategic can go a little further out. But generally is a short-term still as well. But then I think what makes us a little different, some people are dogmatic on technicals the only way to make money, or some people say macro fundamentals are the only way to make money. Well, we see the value in both. We'll marry the two. So we take those technicals, make it giving us a market opinion, bullish, bearish, neutral. Then we take a step back and say, what's actually going on in the world between now and the time of the options we're looking to trade will expire. That's the kind of the macro. That's the kind of, we call it fundamentals, but we're not out there, doing channel checks on Apple or Microsoft or anything like that. What we are doing is saying, what's actually going on in the world? Is there a Fed meeting? Are we in earnings season? Is there a China
historic trade U.S. election?
Exactly. Is there an election coming up? Things that the technicals are great at telling you where you've been. They're rear view looking. Fundamentals, the macro kind of tell you, here's some events that are coming up, and the market will have an opinion and have a price baked into that. So we take that market expectation, marry it to what we think might happen, and then we kind of have a bifurcated kind of a quantum mental approach. It's the numbers, the technicals telling us something, but then this macro, and we marry that together to kind of come up with an overarching thesis. That's where then strategic and tactical will diverge. Strategic will buy ratio spreads, buy an option near the money, call or put. Sell a ratio deep out of the money to offset the cost of that long option. Tactical takes the opposite approach. Still use that same fundamental and technical research, but then says we're going to sell some premium. We're going to capture some premium to for its investment gains. Ideally, that's the difference. They both will express a bullish or bearish or neutral position, but do so in a different way. And that's the correlation between the two is almost nothing. Depending on what fee structure you look at, varies from 0.08 to 0.12 between the two. So they're very different, even though it's both Scott and I working on the research and executing the trades, but it's just the execution of how we express that opinion that makes it different.
And backing up, so there's option specialists, 2 main strategies: tactical and strategic. Tactical shorter term, strategic little longer term. Tactical. And then you're also sub-advisors for a few mutual funds, as I mentioned
Correct.
at the beginning. So those are using the same strategies?
Yes, the Catalyst Warrington Strategic Program Fund takes strategic, and the Rational Tactical Program takes tactical. So different ways.
Easy enough. Right?
Exactly. We're not the most creative in our naming, but that's okay.
Right.
We try to make not too confusing around here.
And so, which you want to dive in first, tactical or strategic?
Let's go tactical. Let's say
tactical's inside of strategic in a way, right?
Exactly. That's kind of the strategic is the older one. And that started in January of '97. Tactical is a little newer. Tactical came on. We started it in May of 12. First started just with proprietary money, then rolled it out to clients once we knew it was a very real program. But essentially, like we said, it takes that market opinion and then expresses it using short-term options. What we're doing is, at the onset of a trade, say, 3-5 business days before expiration, we're going to say we're mildly bullish. So in that case, what we'll do is to balance the calls and puts that we're doing, the sizing of those and the premium we're looking to collect will be expressed will be an expression of that market opinion. So like I said, if we're mildly bullish, we may say, you know what, we're going to sell a half contingent of calls, maybe a full contingent of puts because we're slightly bullish. If we're ultra bearish, we may sell a full position of calls and no puts, a la March of this year.
That was going to be my question of you ever fully on one side?
So, very much so. And that's, like I said, it's an expression of, we are not dogmatic in the always having to have a full position on. Some option traders, I think we can get into the differences like we kind of talked about. Some option traders, the power of theta, that time decay is such a big deal for some option traders. They say we have to have full positions all the time, no matter what. Yeah. And that's a great way to write your ticket out of this business, I think. Right. That is a one step out of the door, because being dogmatic that way, I think is ridiculous, simply because you don't know what tomorrow is going to bring. So that's to the kind of simplistic option strategy. I'm just going to sell these puts every X date. Yep.
Collect that premium. If something bad happens, I'll try and maneuver around it.
Exactly. Which can work great. There's some of these put right strategies out there. They make indexes based on you sell X percentage out, blah, blah, blah. And there's a market for that. I think that's great. But I do think that's where, being a discretionary manager, that's what you're paying us for. You're paying us to say, you know what, this doesn't make sense to have a massive short put position right in front of a coin flip. You're playing a lot of risk for possibly very real returns, but that's not what we're doing. We're doing, we're looking for nominal gains. If you look at our return stream, a good month is 1%. So we're not out there looking for that 20-30% annualized return. That's just not in our cards. That's just not how we operate. But we are trying to do is avoid those big downs as well.
And so how far out of the money are you typically?
On the put side, depends. I would say on an average position, I would say a VIX in the mid 20s, we're 7 to 10% out of the money for about a week before expiration. On the call side, it'll generally be a little closer just because the way, of skew, we may be 4 to 6% out of the money. Again, we're not taking a lot of premium. On an option like that, on a call side, you're maybe taking 20 to 30 cents. On the put, 60 cents to $1. And we'll do that in decent size, but again, not anything extraordinary, so that in a given week, a 25 basis point return is a lot for us.
Yeah.
If you pull up the HRSTX ticker symbol, you see a lot of this
stair
like
step.
that, a little stair step flat, and I get calls with people saying, so are you guys not trading? Well, we are, but it takes, to move a penny, it's about 16 basis points just based on the denominator. So that's, we're trying to be the steady as she goes, kind of boring, admittedly, stick to what we know, but then, try to avoid the big nasties, because that's, so far so good. And we can get into what we do to avoid that, but that's really our calling card.
Yeah. And so if you're not necessarily selling theta, but that is part of the premium collection.
Well, it is, yeah.
But it's not your main goal. So sounds more like you're kind of trading the delta, the direction of the move, but through the options instead.
We are
So
trading.
you don't have to be right on the direction.
Well, I'd say we're just not maximizing theta. I think that's the separating thing. If because these options, it is all theta because there's no intrinsic value to them. That's really where we're making our money, but we're not ramping it up so much. I think that's where I differentiate us between other options traders.
I guess you're not coming in with a view on implied is expensive to relative, so we're going to sell, right? It's being sold no matter what.
Exactly. There are times where we would rather have implied greater than realized. We want to have that, obviously, but that won't preclude us from doing a trade, especially if it's 2-3 days before expiration and you're selling an option 7 to 10% below the market, something like that. If we can get an okay, that's the, weighing the potential risk and reward. If we can make those 20, 30 cents on a high probability trade, that's what we like to see. It's not but there's no dogmatic kind of trade based on that. There's no, we have to have a position. A lot of it is, okay, look, here's this, and I like to point to it. We've been staring at screens for 20 years. In Scott's case, 30 plus years. So there's that feel from the market. You stare at a screen long enough, you get that feel of like, this doesn't feel right. My spidey sense is off here. And that's a lot of times the indicators will back that up, but just seeing the feel and getting in the flow of the market can really reinforce, sometimes it's good to be conservative rather than aggressive. And generally we're going to err on the side of conservatism because of that.
But inside that conservatism, so if you're trying to make this 25 basis points a week, what are you risking in order, theoretically, what are you risking in order to get that? 10%, 5%?
The obvious risk of any short option is potentially unlimited. We have to say that, of course. Of course. The way we hedge them is we say if this position starts to, and at the beginning of every trade, our risk management comes in and says, if this, say we have a put that's 10% below the market, if the market drops 3% in relatively short order, say we're 4 days before expiration, that type of move will generally trigger us to reduce that position by half or push the entire position down. Not out in time. Generally, we don't like to go out in time because in the current market, we don't think you're compensated for rolling out.
Yeah.
It doesn't seem to be there. But in that case, if the market goes well before we're moving 10%, if you sell that option for, let's say, 80 cents and it's still 3 days before expiration, you drop 3%, that's probably going to be $2. Just using estimated numbers here, of course. But that type of trade is like, I'll risk that losing that $1 or $2 because you lose 10, 12 basis points on that trade. But in order to keep maintaining, all right, we can sell that 80 cents and we can sell that $1, knowing that that's our trigger point to kind of minimize the risk.
And do you ever worry or feel like the other side is overcharging you to get out of that? Right?
Oh, without a doubt. Yeah. I mean, there's always that risk. It's not necessarily an overcharge because there's, when you're doing these trades, there's, you're trading with 2 dozen, 3 dozen, whatever different people. Yeah. So there's always other market makers, and that's it's a matter of, we're not that big of a player. Our largest fund is 220 million. So that's big enough for the space we could move the market if we dumped we did a full trade at market go kind of thing. Yeah. But that's not really how we trade. We trade in bits and pieces. That's that's our MO. We prefer to step into and step out of trades as needed.
I was curious because your long vol counterparts are like, we're the liquidity provider, and these guys are seeking it right at the wrong time, and we're going to just be sitting back saying, okay, right? Like Eddie Murphy in Trading Places, like
right. All right. And I think the key is to do your hedging preemptively, because if you're coming in and if you're doing that trade when you have to, that price is going to be worse than you expect it to be.
Yeah.
But if you say
like the Volmageddon and those people at 305 trying to exit those options, and
and I have a good anecdote about that specific week right there, but I'll jump into that in a second if you want to. But I do think that's it. I think that's one of the separating factors of we're hedging these positions. We'll talk to other people like, why are you hedging this? Why are you getting out of that position so early? It's because of that point exactly. We don't want to be buying this into a fast market or looking in a bid wanted situation. Or on the opposite, a extreme melt up. We don't want to be covering calls when the market's screaming higher after they announce a vaccine is, available to everyone tomorrow or something like that.
Yeah.
So that type of potential risk out there, we seek to avoid that by hedging early and, oftentimes hedging unnecessarily, admittedly, but that's okay. We're fine with that.
Hedging means that pushing it out or covering?
Generally either covering that risk or pushing it up in strike, generally not pushing it out in time.
And not buying wings or something of that nature.
Yeah, usually not, because then you're just making a short spread and you still have a lot of exposure.
Right. And you're not doing any delta hedging or things of that.
No. I think with that kind of stuff, we don't like to use the futures for the delta hedging like that, because one, the options we're trading have such low delta that once they acquire that delta, then we should have hedged.
You want to be out anyway. Yeah.
Exactly.
Right. You're putting on one micro.
Exactly. It's like, it doesn't make a lot of sense to do. And especially since we trade the mutual fund alongside a lot of SMAs. So you have to kind of parse your positions to say, all right, here's my kind of least common denominator. We need to do at least this many options in order to kind of allocate across everything. Things you have to think about in that kind of situation.
So you mentioned an anecdote about Volmageddon, Feb 18. What was that all about?
What I'd love to use that one as an example, because you look at our return that month, we had up like 1 point, depending on the program, 1.2 to 1.5%. Both programs, strategic and tactical, were profitable. And one of the things we'd like to use, one of the tools that we I'll put that in our technical indicators,
which seems totally impossible for a short vol program.
Exactly. Because a lot of we know how many funds that shall not be named went out of business that month. That's because of that dogmatic approach. We have to have a lot of short volatility no matter what, and then when VIX triples in 2 days, you get in a lot of trouble.
Do their names rhyme with RJ Smuckers?
In that range, yes.
Yeah.
We had a lot of calls that week, like, how did you make money and how did they lose so much? So anyways,
I'll say, if we had a nice blog post, we'll put it in the show links on LJM, what went wrong, massive notional exposure.
Exactly. They were very big, and and I can't speak to how they trade. I just know they were very big and they lost a lot of money. I can't say here's what they did, but I can tell you what we did. So if you rewind to the Friday before that, one of the tools we like to use is looking at the slope of the VIX curve. So generally it's, positively sloping, spot VIX is underneath month 1, underneath month 2, yada, yada, yada. Very nice and boring, kind of positively sloping. When that inverts, when there's a double inversion, when spot VIX, the cash VIX we all see on CNBC or Bloomberg TV, when that goes above month 1 future, which is then in turn over the second month future, you get that double inversion. When that happens, that's when it's potential for crazy volatility. Friday, I think February 2nd, 2018, the VIX curve inverted. Middle of the day, probably 1 o'clock Central Time. So we saw that and we're like, wait a minute, that doesn't look good. Market was already weak that day. We said, what we're going to do? We're going to close out all of our positions for next week. This doesn't look right. Again, it's a feel of the market falling into, after, because earlier that week, the market had peaked that January. It was crazy. We were screaming higher. Then all of a sudden the market really started tailing off very quickly into end of January, early Feb. We saw that and said, that doesn't look good. The feel of the market's not great. The technicals are telling us the VIX curve inversion is flashing a bright red light. So we closed. So tactical went into the weekend with no position whatsoever. I think we had some short calls well above the market, and strategic had nothing. Obviously, history then shows us Monday volatility goes crazy. Tuesday it gets worse. At that point, we're sitting there looking for opportunities. And after probably 3 or 4 more days, we then stepped in. Once we kind of saw, things return somewhat normal, figured out what the root cause of this was, and said, okay, this is some things were going on. Some funds blew up that kind of probably exacerbated it. And then we're able to, look for opportunities.
Then as a vol seller, it's green light go, right? It's like
not fully. It's hindsight being what it is. It's easy to say, oh yeah, sell everything you can. But in that case, we're like, all right, let's step into trades.
And we did go 12 to 30, 12 to 28. I can't remember.
I'd have to look back. I think at least 30, but it
wasn't 80, right? So
no, it was not.
That's the issue
not.
there. Like, okay,
Exactly.
we're selling at 30. What if it goes to 80?
Exactly. And that's the trick right there. And people ask us that same thing, like in March. Well, why didn't you sell a lot of premium in March? You should be, VIX was at 60. Yeah. Well, that's great. But like you say, if the market goes, if you wake up tomorrow and we're limit down again, how many times are we limit down?
Yeah.
That just doesn't make a lot of sense to us.
Right,
we're not swinging for the fences like that.
Yeah. And I think like 87, all the VIX wasn't around, but it would have printed like 128 or something.
Something like that. Exactly. Some insane number that, people, and even that with the crazy delayed tape back then. So,
yeah. And then, so take us into March 2020, because similar, you'd think vol, you'd think option seller, you'd be taken out in a body bag, but it worked out for him.
So in that case, we saw, if you look at a couple indicators that we were using, even as early as January, we kind of saw, the VIX curve got flat. We saw a number of things that told us, wait, this doesn't feel right. It doesn't, there's underlying weakness in the market. There's not a lot, the index was doing fine, but it did not look healthy. And we had some indicators telling us this. We then took a step back. So the technicals were saying, be cautious, but we didn't know. There wasn't some bright red light saying, go to the sidelines, be careful. Yeah. But at the same time, we use that macro like we talked about. In middle January, late January, we see this, the flu and going on in China as virus, it's all over there. And admittedly at the time, we thought it was going to be more of a supply chain issue. If this is affecting China as much as it looks like, and you make a product that is dependent on, you make a widget that's dependent on something that's coming from China, you may not be able to sell your finished product, may hurt your profits. That's kind of what we thought. We are not virologists. We're not going to say we are.
Yeah. I remember I had forgotten until you just mentioned it. I was buying like water and food because they were like, the supply chain's going to get, even the foods, which happened a little bit, but not nearly as much as everyone thought.
Medicine, things like that. I was kind of, saying like just stock up on things that you have to have. Obviously did not anticipate what it became, or else we would have been outright short. But that's not really how we trade either way. But that was the technicals telling us one thing, combined with the macro of this thing going on that could be something we don't know, told us to get conservative and be careful really early. Now that just means we were just dead wrong through a lot of February, because February just was a pretty strong month until the very end. At that point, when we saw, okay, wait a minute, Italy's a mess, creeping into New York. Let's batten down the hatches. During the month of March, Tactical never had a put, long or short, in its portfolio. We made about a 25% or 25 basis points return that month, just selling short calls. Strategic had a pretty decent month because we were able to do the same thing. We were able to do essentially just long put spreads and make some money that way. So that's the MO. We're out there to take a big, large position in that type of market, even though volatility is great. Like you say earlier, it would be wonderful to short VIX at 60 if it goes to 2 or goes down to 12. Wonderful. Yeah. But if you short VIX at 60 and it's 110 the next day, then dust off your resume.
Right. Exactly. And that's part of what'd you say? Scott's been at it since 97.
Well, we started strategic in 97. He started in the early 90s. He's got an interesting backstory if you want to get into that. He started with his family ran a manufacturing company in the 80s. They sold it, and he was tasked with investing the proceeds. He found a local hedge fund. This is a hedge fund in the late 80s, early 90s in Dallas.
Wild West. Yeah.
Exactly. This is, and even more so, this guy traded futures options. So Scott found it. They invested some money. Scott went to work with him and learned option trading from this gentleman named Stan Finney. That's where Warrington and that's the genesis story if you look at it that way. Once he, kind of learned how this gentleman traded, he found out, hey, this is a great way to really, invest money. But that trader was very aggressive. He's the typical, really strong ups, strong downs, tough to really, stomach those 25% months, both directions. So Scott learned from him and tweaked it and said, let's change what he does and take it into, a little more conservative version of that. And that's kind of where strategic came from. So strategic, he said, this gentleman sold premium aggressively. If we tweak that a little bit, use the proceeds of that short option to then fund the purchase of a long option. That creates that ratio spread. And that's where strategic started from. So that's the big difference between strategic and tactical. In this case, and strategic will take the proceeds of those short options, funding a long option, stripping away some of that volatility. It's a ratio spread. It's not a 1-by-1.
And what does that look like let's just use fake numbers on the S&P at 3,500?
Sure. So a good example in a normal market or today, because today's kind of trades, everything is, we're not going past Friday with any of our positions yet, and we're keeping them extremely far out of the money. So our long is 200 points out of the money because we've seen moves, so we have a 200 point, probably a 150 point 1-by-3 put spread, but our long is about 150 points below the market. So you've got this kind of, we call it a bear trap. Because we are seeing these, down 90 point days, if you put that too close to the market, one, it's going to be expensive, and two, you can get blown through really quickly on your ratio. So the way we've been trading that one, and that one's had a tough year. Strategic's up, but not much, about 1.5%, depending on the program you look at. It's done okay, but nothing spectacular because of these, no volatility.
You've had a lot of realized volume.
Exactly. It's moving pretty well. The implied vol has been mostly high, but not, in months like March, strategic is going to sit on the sidelines. It's just going to not really trade very much because a VIX of 80. Neither of our programs excel. We love a VIX of 25 to 30. That's great. There's a lot of opportunities there, but like you said, that realized vol is a lot higher than we'd like it to be, but that's part of the deal sometimes.
And so let's go back to the general example, 3,500 S&P. You're selling put spread.
We'd buy a put spread. So we'd buy a ratio spread for strategic. So in that case, they were moderately bearish. In a normal market, if the S&P's at 3,500, we're probably going to go long at 3,400 and then sell 3 down at probably 3,250, 3,270, somewhere in that range. So you have a decent, and that's for about a week to a week and a half before expiration. That's the normal type of position,
And so the risk there is you're overweight on the sell side.
Right.
So it's a short gamma trade.
Exactly. Right. You're taking in. So the ideal is that if the market goes sideways to slightly down, and then eventually your shorts have decreased in value, but your long has held its value or increased. And that's that relationship you're looking to take advantage of.
Right. Perfect.
That's what we want.
Scenarios pin right above the short strike, right?
Ideally, but even
that'd be too scary. But
exactly, that's generally we're out of it long before that, unless it's somehow magically Friday afternoon and we're trading it right there. But most times, if that kind of position, we're going to go into it with it's going to be close to delta neutral at onset and almost no cost. So that's kind of one of the ideas of strategic as well. We want it to be cheap. We are not looking to spend a lot of money on these. We want to go in with minimal cost, but then, ideally sell, buy it for 20, 30 cents on the package, but then come in and sell it for $4, $16, $20, whatever, if we're right.
So you do want to move in that direction.
Yes.
So
strategic develops
a lot in that direction.
No, exactly. We don't want to, in that kind of situation, we don't want a 20% move, but a 10% move would have been fine. And something like that. That's the MO. So strategic develops delta as we approach expiration. At the onset of the trade, a week to a week and a half before, it's delta neutral. We're slightly short gamma, especially if it accelerates. We'll pick it up pretty quickly. Yeah. And that's where that risk management comes in. Because like with tactical, there are short options. So we know exactly our risk points. We set up before, even before a trade. Sometimes we're looking at a trade and say, this looks good, but if we need to hedge it, it's going to be a mess. So let's hold off. We've done this 20 stinking years. So we've seen a lot of different iterations here, but that's a thing that we'll often do where we say, the risk management on this trade doesn't make a lot of sense. So we need to hold off, scale back, adjust. But the same kind of preemptive hedging is what we're doing. And for tactical, we're doing in strategic. But because strategic has, like we say in that case, you have a long option and then 3 shorts. So you've got 2 exposed down below your short. So oftentimes that's where we're hedging. That you cover one exposed option as the market these, climbs or falls lower, or climbs if we're doing a call spread, and then you cover the other one as needed. So that's the idea. You don't have it on at the beginning, but then you have it on as as the market moves.
And same thing as tactical there, that you could have on both put spreads and call spreads?
Correct.
Or you can shift one way or the other?
Precisely. So a lot of times we'll start, if we're neutral, we'll put on both a call spread and a put spread, both with minimal cost. And we just want one of them to be right. If we spent 50 cents in total across, the entire, portfolio, that's not a lot of money. When you multiply it up with the multipliers and you scale it up per account, it's not a lot of money we're talking about. I mean, we're talking 10 basis points before costs or before fees. So it's not a lot of money what we're doing there. But the idea being, if we can monetize either side, then that's a winner.
So help me understand the basic principle there, because harder to understand than tactical. You're not necessarily long ball. You're just kind of absolute return, but you kind of view it as you're basically trying to get a free straddle or strangle. Right.
Essentially, it's we are short vol at the onset, just slightly short volatility. But as we approach expiration, it develops, depends where we're at. If we're close to that call spread, we're going to develop a long bias. We're close to that put spread, we're developing a short bias. So that by, expiration or the day before, it can have some serious delta to these positions, because we are, our shorts are so far to the money, 150, 200 points away, but our long may be 20, 30 points away, or in the money even sometimes.
Right. But there's no downside to that. That's kind of like the free put option there.
It's a free option. Exactly. Yeah. That's the
huge caveat that there's those shorts.
Exactly. Because that's the thing. If it goes too far, we've seen those a couple of times this year where the market, comes in doing exactly what we want on an expiration day. So we'll have to monetize it, but then, you can't just monetize your long option. You can't sell it out and keep your shorts out there. You've got to close those as well.
So how do you, switching gears a little bit, how do you explain all this to your typical RIA investment, right? Is his head or her head spinning by now? And just especially in Texas, I don't know if I just made some enemies down there, but just just give it to me straight, partner. What are you trying to do? Sure.
So essentially with tactical, we're just collecting premium. That one's easier to explain. Most people, get it. You sell an option, you sell insurance to a guy and hope it doesn't rain, and you plan for accordingly.
And are you getting, see, I can't even do it. I want to get more into the weeds right away. But
I know,
are you saying because some people say, hey, we're risking a 10% down move in a week to make 25 basis points free, right? That's the risk, is we're risking this event happening, or that's what we're selling, insurance against this event happening.
It depends on our market opinion, but yes, I mean, that's the idea. It's hey, we are cognizant of the risk of, selling options. We totally understand that. We are forthright. We're very clear that, hey, selling options carries risk. We got that. But here's all the things we do to mitigate that and hope to just, avoid those pitfalls. One, it's easy to point back at our track record and say, look, here's what we've done. But that said, there's no guarantee of that's happening tomorrow. Of course, not even a CYA, but it's just it is true. Yeah. But, I think what our process does, it allows us to kind of say, we're identifying these potential issues and we're preemptively acting accordingly. So getting back to the kind of the elevator pitch for strategic is that it's essentially, it's a mid-range volatility program. But what we're trying to do, the elevator pitch is say, we're trying to capture range in the market. That's all we're trying to do. We construct option strategies to kind of say, hey, here's our market opinion, and we want to capture that range by doing so. We're going to spend a little money to do that, and win, lose, or draw, we're going to go back to the drawing board, next week and do the same thing, but based on a different market outlook. Because as we've seen, our market opinion today is going to be very different than it is a week from tomorrow, perhaps. And then you tell me what that election looks like, et cetera, et cetera. Yeah. But these type of things happen. It's not usually not as stark, but our market opinion does evolve over time, and we just kind of wash, rinse, repeat. We start with the technicals, do the fundamentals, express it using options.
And would most people put you as equity replacement?
We get bucketed in that sometimes, only because we're trading the S&P. Yeah. I tend to say, don't look at us there. Look at your non-correlated, your alts, and say, what am I doing there? pair us with some trend followers, some other alts. And, we would argue that alts bucket needs to be 35 to 40%. It needs to be higher than most people anticipate because, bonds have done pretty well for you this year. Will they do this well every year? Stocks were, if we had this conversation.
Especially coming from here. Right.
Exactly. It's like, they've had a great run. Unless rates go negative, that may not, you may not want to expect that in the future. Same thing if we had this conversation, 6 months ago, you were telling me how your stocks are the worst thing in the world and you never want to own Apple again or whatever. But that's, obviously they've had quite a run. But I do think, depending on your outlook, you shave your bonds, maybe put more toward alts, not just in Warrington, but like we say, other trend followers, some long gamma, things like that. You diversify that bucket because our correlation to anything out there is just almost non-existent. I mean, it's strategic correlation to stocks, bonds, other alts is almost zero. Tactical, same thing. And tactical to strategic is almost zero as well.
And that's a big theoretical thing, right? Can you have long gamma and short gamma at the same time?
I would say
you're buying and selling the same thing eventually. So there's someone smarter than me will have to figure out, like, mathematically, you can't be in that position. Or like it could get arbed away or something. But
exactly. Like for us, because we're not just a short gamma shop, I think that's why you can do that. Because there are months, February of 18, March of 2020, where we should lose a lot of money if you call us a short gamma shop.
Right.
And that's, obviously not the case.
Or the first Trump election, right? That was the mother of all gamma melt-ups that took some people out.
Oh, yeah. Yeah. Especially if you were short a lot of calls and, and even that January, February after that in early 17 was kind of a mess for a number of funds.
Yeah. What are you caught my eye when you said, my ear, you're trying to capture the range. Do you feel like the Fed put and everyone's trying to basically clamp down on volatility feeds into that? I was like, hey, we're trading this thing, and per the tea leaves, that's exactly what the handlers of the market are trying to create with their monetary policy and telegraphing what they're going to do way ahead and things like that.
So you're asking, do I think that they're going to, or how does that impact us?
Yeah, just basically, do you think it meshes well with the world we live in of like the Fed's going to keep the lid on volatility for as long as they can? Maybe they're out of bullets. All those arguments, but
they're sure trying to pass that baton, and I don't know if they're going to be able to. But how it dovetails with us is that we can make money in low volatility environments or high volatility environments. We don't need a specific. I mean, ideally, if you said, Mark, I'm going to give you a VIX of 17 to 25 for the rest of your life, that's wonderful. But who knows what that will bring, and the Fed would like that too, I have a feeling. But as we've kind of seen, even in this year, the Fed was trying to keep a lid on volatility, and look what happened. So, I think they are not the Wizard of Oz wizard behind the curtain that can control everything. I think they're going to try to. Yeah. But I'm afraid that, like you said, I don't know if they're out of bullets, but I think sometimes their bullets they can't work for the problems they've created.
Yeah. But some would argue they did it, right? It was like a quick 1 month down move and right back.
That's true. That's a very good point.
Like there's tens of millions of people without jobs and whatnot, but the market came right back. Are you hearing all this talk about dealer gamma and the VEX and Vanna and all these second order Greeks and basically where the market makers are hedging? Do you guys give any, what are your views on that? Are you using those as indicators?
Don't use them as much. I use the gamma exposure a little bit, but because we're so short term, we're not going out very far at all. And I think some of those are good tools, especially as you approach an expiration. I think that's one thing. We'll look at the open interest across a number of different markets and see, like we've seen, there's, X many billion of notional in Apple. Yeah, well, that's fine. But if it's, $20 out of the money, that's not going to have any real effect. So that won't do anything. But if I see a lot of close to the money S&P specifically, or NAS options, those are ones that'll catch our attention. And that's where we'll kind of pull in that research and say, all right, here's, the bias may be this, but here's where gamma is going to have a potential issue. And we, short term, we don't necessarily trade around it, but we will use that to influence our, how we unwind.
That discretionary piece, right?
Exactly.
So if you're like, hey, we love this trade, let's put it on, system says it, but look at right at that first strike, there's tons of gamma there.
Exactly.
That could
Precisely. And that's going to go off the
through to
books.
the second.
Precisely. That'll act as an accelerator. So yeah, the very, very, very good point.
And then you mentioned Apple. Do you have any fears or concerns or thoughts on those FANG Plus becoming bigger and bigger part of the index?
Oh, sure.
Like at some point you're trading Apple instead of S&P, right?
You know, that's one of the reasons why we don't like the NASDAQ, and we could take our strategies and apply it to other indexes, but we don't, because the S&P is still broad enough that, yeah, Apple and Microsoft are 5-6% of the index, not 25.
Yeah. So
that helps. I do think just for the health of the market, you know, companies getting that large is not great, because if XYZ happens, because then you get that headline risk. You know, we talk about this phrase headline roulette a lot, where we're, you know, maybe doing some research, working on a project, giving a presentation, and then, you know, you check your, you know, Bloomberg alerts and, oh, wait, you know, we just banned WeChat and therefore, you know, no Apple products to be sold in China for 10 years, you know, that kind of thing. You know, those are disconcerting. But again, because we are focused on the S&P, it's less of an issue than it is in the NASDAQ. The NASDAQ is so concentrated that you're trading, like you say, 5 stocks. And
and you have to become expert in, right? Exactly. Your indicators have to shift to what affects those 5 stocks. Precisely. But it seems like that's into the S&P too, because it's 5%, but of each of those, right?
Right, exactly. So it's not 70% of your index, but it is 25. So that's enough. But yeah, they're heavier weighted than I'd like to see, admittedly. I definitely would like to see a little more broad-based.
You still had, right, like in March, Boeing falling through was causing S&P losses. So
exactly. And in that case, like Boeing just absolutely killing the Dow because it's silly price-weighted index instead of market cap.
Exactly. Right, but nobody trades Dow options. Right?
Yeah, I know. We used to. When I first joined, we did trade Dow options in the early 2000s, and as we kind of looked at the open interest, we realized, we looked around and we were the last one in the room. So it's like, we can't do that one anymore. So.
And what are I had some ones I can read you here, but also what are your thoughts on just what some of the biggest mistakes retail or even professionals make when they're selling options?
Oh, sure. The most common one is falling in love with just the premium price, you know, completely forgetting what risk is. You know, the slippery slope of, like in our case, we're selling something for $1. Like, well, hell, if I just move 20 strikes closer, I could sell it for $2. Well, if I go a little closer, I could sell it for 3 or 4 or 5. And then all of a sudden, you've got a 7, 10, 20 delta option that I took $5 in, and that's great, but it's going to be 25 when Trump tweets something or things like that happen.
So you sold it for the same dollar amount, but it's 10 times riskier.
Precisely. You bring in too much, too high of a delta. Not appreciating preemptive risk management, I think, is the other big sign of it. Knowing that, if the market starts barreling toward your position, extend and pretend doesn't work. If you go out there and you just push it out in time, because you don't realize that loss immediately, but you took on a lot of that time risk. I mean, properly valuing time risk. If you have an option that's going to expire in 2 days and you make it at one that expires in 12 days, all of a sudden, that's a very different trade. It's a very different trade. So I think not, avoiding that, just being a good risk manager, I think is the biggest thing people can learn. And usually it's really expensive.
Yeah. The, right. What's the, Patrick Malady, do you know him? He does, he runs a fund, but he always brings it back to a pilot. And like, you could fly 10,000 flights in your life, never have an issue if you crash on the last one and kill all the people, right? Yep. Like it didn't matter. Those other 10,000 didn't matter at all. So
Precisely.
That's why a pilot, every time they get in the cockpit, goes through the checklist. That's all.
Yep. Treat it like that.
And so we mentioned rolling out the positions. That's a famous one. What about like treating calls and puts the same?
In what way? As far as balancing them in how you trade, or
just
how
like
you execute them?
No, like more of like just selling options. I'm going to sell them an equal amount out, or selling both sides.
Right. Yeah, calls are very, very different than puts. Because generally, now this is interesting. What we've seen a couple times this year, We had that melt up.
Counter to what you're about to say, right? Yeah.
Exactly. You all of a sudden you saw the market scream higher and volatility go. And that's, those type of situations are usually triggers for us to, again, manage that risk, go to the sidelines. Because if volatility is increasing, generally volatility is decreasing as the market goes up. That's the general rule of thumb. That's why when puts get really expensive as the market's cratering, but as the market's climbing, a lot of times calls don't price up. They kind of flat, and then kind of accelerate. So hedging that before that, what we say, like I mentioned, what we've seen a couple times this year is that volatility increasing when the market goes up. That's a different situation. That's more akin to how puts price. That's, so we'll treat those as puts, hedge them very preemptively. Whereas sometimes we'll give calls a little more room to work intraday, not overnight. We don't like to do that overnight because you do have gaps. That's part of the problem that we're seeing. A lot of, news flow overnight, gap up 30, 40 points, then all of a sudden you can be in trouble. So we want to avoid that type of situation. Again, that means we're hedging options unnecessarily, if you will, if you say in the rear view, but we want to hedge that prior to it becoming a very real issue. So I think they are different in that sense, but you have to treat them, with kid gloves both ways.
I think you said this is one of your things, but another retail possible mistake, like selling it right before earnings, a single stock name, or right before, say, an election or a Fed announcement.
Right, because we know one thing we like to say. We know when we don't have an edge. This election specifically is, I don't want to call it a coin flip, but there's enough factors where we, as a small shop, we're not doing exit polls, we're not doing this, we're not conducting our own surveys, so we don't have an edge there. So you're not going to see us take a massive position. We may not have any position, depending on how this thing trades before then. That may be a 3 days of being in cash, and then we reevaluate. But that's one thing we've learned over the years, to know when we don't have that edge and then stand aside if need be.
I'd argue some of those big firms that are have their own polls and everything, that creates a little bias towards your own information.
Sure.
Way more hurt than you would.
Security. Yeah, exactly.
Another one, holding your options when they're not worth anything. Like if you're short and you're holding cabinet bids, what are your thoughts on that?
Depends. If it's day or day of, sure, fine. If it's that far out, a lot of times that money is just sitting fallow, and you should either, roll that closer if you're committed to that position, or clean up your books. Having a almost worthless option sitting on your books for too long is not a good idea, I don't think. Yeah. But if it's the day of, the day before expiration, then I think that's an okay risk to take, unless if you don't have a position that you need to take its place. Because that's, in this world now, margin is a very real issue. We have had, margin, FCMs keep raising margin into the election. So that little tiny option that, like you say, maybe cab, that it's sitting there taking up $15,000, $20,000 worth of margin, and that's a waste. So, you don't need to put that up if you don't have to.
What are your thoughts on some long ball people would say that most of this, 1x3 spreads or outright selling is like a terminal break even, right? Like eventually it's going to lose money. It just hasn't yet. Since 97, and you're kind of, right. You're solving that by we're not always doing the same trade day in and day out. That would make it more terminal break even. But I could argue it's still terminal break even. You just have skillfully picked when you're getting into those trades. And if you had a long enough time horizon, eventually it would hit you on one. I don't know. Possibly. What are your thoughts on that? I
think I'd say my general thought is that's kind of where, as discretionary managers, we're saying we are market timers. We are making market timing decisions. And some would say, oh, you can't do that. That's impossible. Well, I would disagree in that sometimes we are, saying we are agnostic on the market, and other times we are taking a position. I think that difference, if we are, like you said, always had a position on, I would agree with that statement. That we are terminally doing a break even, proposition if we always have this on. But because we are going in and out, or hedging quickly, or being aggressive, it's that manager skill I think you're paying for, and being able to, time the market, being able to look for positions that, or look for opportunities that just a standard index won't. I think that's what differentiates that. And that's why I do think, I would disagree with the notion that it is a break-even analysis or break-even proposition long-term because of that.
Yeah, and it assumes you hold it till expiration. A lot of things,
Exactly.
right? Like
and that's the thing I love about options. It's like it's some cliche 3D chess, 4D chess, but there's so many different iterations. Yeah. Is it this expiration versus that? How far out of the money? How many of them? Long versus short, spread versus outright. I love options for the creativity. With a stock, you're either buying it or selling it. Okay, it's a little different. So I love the flexibility.
I call it 3D chess on the water with sharks with lasers on their head.
Which could be. There's risk out there, without a doubt.
You mentioned you've tried it on other indices. Have you tried it on like bonds and currencies and whatnot?
We've never tried it on there. We've paper tried. We've looked at it.
Like
this is. Yeah, there were some that we looked at. Yeah, was it gold, silver, nat gas, crude, euro and yen? We looked at years ago. And there's certain aspects for what we do, especially in the strategic side. Tactical, I think, could be in a lot of different, it's premium collection and risk management is what tactical really boils down to. Strategic, though, needs a number of things, liquidity, option granularity, a 1 delta hedging instrument. Getting that, that underlying, that's why we prefer the futures options over SPX. There's your basis risk if you all of a sudden are using SPX and then you have the ridiculous expirations every month as opposed to quarterly. So we looked at those. Again, it kind of boiled down to where's your expertise? We like the S&P because it's kind of a macro mentality. Everything is impacting the S&P, currencies, energy, financials, technology, momentum, everything is kind of building into the S&P. And so therefore we can, be, I guess more macro generalists as opposed to crude oil experts. Right. I think fast forward, 5, 12, 10 years, whatever that number is, that I would like to see us expand to those. But I think that's bring on a research team that is these people are focused in blank. Is crude oil or whatever that is. But those are very different markets. I mean, right now there's so much more capacity in the S&P to do what we do that we don't really have a desire to really expand that way.
I see it from the flip side, from the long vol side of these managers of like, hey, S&P vol is too expensive. So I'm going to go into proxies in gold or bonds. Right. So you could flip that on its head, right? Of like
exactly. That would be find the market where the best, risk reward is like, oh, exactly. Yeah. And that was really what started it to say, all right, with S&P may not always have the best risk reward based on what we need, but that's where I think strategic has it's good. It's flexibility to kind of tweak those positions and kind of fit them to the volatility.
And it's interesting. You're saying like which I agree with. S&P's got all those factors coming into it. Like most people say that makes it almost impossible to trade, right? Because there's so many factors coming into it. You don't know which way's up a lot of the time.
I like it because you don't have. It's not. I'm not sitting around waiting for an EIA report. It's not a binary market. A lot of capacity. Okay, market goes down, et cetera, et cetera. There's a lot of we call them cross currents. There's a lot of things that are impacting trade deals, everything. I don't need to list them all. There's so many things that are pushing the S&P on a daily basis that I think it's a really good representation of the world economy. It just is what it is.
Yeah, and where the world comes to head, just been kind of shown in March and everything. If you're worried about the virus, you're coming to buy puts in the U.S. You're not buying them on the Italian exchange or whatever.
Precisely, because you want to make sure that exchange is going to be on the other side of it or somebody,
Exactly. Finish every pod going through a few of your favorites. So we'll start with we already talked Cowboys. I was going to say Texans or Cowboys, but you already.
Oh, definitely Cowboys. But I'll put Mavericks over the Cowboys any day of the week. Any day of the week.
We got it. Mark Cuban. We want to get him on the pod.
Oh, I don't know him, but I've run into him a number of times. He in our building down in the Crescent. I've bumped into him a half dozen times. He doesn't know me, of course.
No, yeah,
know
I gave him a
so.
business card way long ago. I used to have bowl season tickets, and he was there with the Mavs. And I was like, Mark, and he just turned around and I gave him my card. I think he dropped it or threw it away. But
or he's going to call you tomorrow. You never know.
Yeah, tomorrow. What about college football down there?
I don't have a horse in that race. I went
SMU?
to WashU, SMU for grad school, but as an MBA, it's not the same experience. WashU is a Division III school, so it just the football was. There were more. I went to a public high school here in Texas, so the football. I was not on the football team, but our football team was pretty good. Go Owls! There was probably in the playoff games, 15 to 20,000 people there. Those type of things.
Friday Night Lights
kind of stuff. So do you go to see that at WashU where there's 200 people there for D3? Mostly girlfriends and parents.
I played D3, and it was and I grew up in Florida, so way less people in attendance in college than I saw.
Precisely.
Same
So,
thing.
but no college team. I'd rather the Longhorns win than A&M, but that's
All right, no horse there.
I
How
won't cry
about
about
favorite Dallas barbecue spot?
Probably Lockhart's. They use this what's the wood they use? Post oak that has such a different flavor than the hickory mesquite kind of thing. Oh, it's phenomenal. It's great.
And how about Dallas versus Austin? Everyone loves Austin.
Oh, easy.
No one talks about Dallas.
Austin is cool and it's great. You're gonna go out partying and stuff, but I want to raise a family. That's the thing. I've got kids. I don't need them to be wandering down to 6th Street and partying a little too much. College, they'll go to college. That's fine. But Dallas, I love Dallas. Dallas does not have a great reputation nationally that way. Houston has its country and oil, and Dallas is, little finance and yuppiness, if you want to call it that. But I love it. It's a great town. Great town.
I mean, that's every dinner, every time you see friends here, everyone's complaining taxes and pension, and they're like Nashville or Austin.
Yeah. I mean, Dallas is right there. You drive around, there's probably more California plates than Texas plates all of a sudden. It is very common to see a lot of transplants because, frankly, compared to even probably parts of Chicago, I'm sure our real estate is cheap compared to you guys just because, we don't no land borders. There's not a Lake Michigan kind of boxing us in. So
you can just go a little further northeast, south, or west.
Exactly.
Texas is so big. Favorite vacation spot inside of Texas?
Ooh, inside of Texas.
Yeah.
It's not my favorite. I'm a beach guy. I love the beach.
Big Bend National Park. You ever been down there?
I've never been. Can't say I've ever been.
I want to go do that.
Rough Creek Lodge. It's kind of a really nice little place, about an hour and a half out of here. It's kind of an outdoorsy but nice enough place. That one's pretty good.
All right, I'll take outside of Texas.
Outside of Texas, easy. It's a place called Inlet Beach in just east of Destin, in between Destin and Panama City. In that area, right next to Rosemary Beach. That's my happy place.
Where Hurricane Zeta is going to go.
Again, they get. I don't want to own property there, but I'd love to visit there. So,
and finally, favorite Star Wars character.
Got to go Han Solo. I'm a Han Solo guy.
Right.
A little confident, and he always had the coolest gun. I love his little blaster. Actually, I just sat my kids down and watched episode 4 with them. Nice. 2 weeks ago, and it stuck. My 7-year-old was a little hesitant when I told him space samurai with laser swords. He's like, I'm in. So it worked.
Are they Mandalorian fans?
Not yet. I did a little research on how to progress, and it was like it's called the machete version where you start at 4, 5, 6, you skip 1.
Yeah,
it's some weird thing it's going to take us. That's, they're doing school from home. So I'm like, all right, let's, every so often we'll do a fun thing on the weekends for you guys, watch one show. So we're a long way away from the Mandalorian, I'm afraid.
It's coming back Friday.
As they say, it's coming out soon.
Great. Any other comments on so where can they can go to the Catalyst website and then go to the Rational Funds website?
Yep. Go there.
Where else can they learn more good stuff about you guys?
You can go to our website, warringtonasset.com. I think they're the Catalyst and Rational websites, are really good. I think some of the materials they've made are phenomenal. I think they have a really great team that has put together some stuff that really highlights. So here's what we've done in certain situations. Here's the history of the fund, and I can't go through your RIA and they'll be able to get through the sales rep, the proper materials for you. But I think there's a number of things that they put together that really kind of highlight that in a 3-4 pages, versus listening to me chit chat about it for an hour and a half. But that's a nice, succinct way of capturing our returns and understand what we do.
And they've got some good little video of Scott on there as well.
Oh yeah.
All right, Mark, it's been fun.
Awesome. Thanks, Jeff.
We'll post all the links and everything in the show notes. We'll talk to you soon.
Thanks. Appreciate it. Have a good one.
Yeah.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlt and visit our website to read our blog or subscribe to our newsletter at rcmalt.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.